Good morning and welcome to Climate Change and Shareholder Engagement. Our session today is with Bruce Duguid. He is Head of Stewardship at US Equity Ownership for Federated Hermes. Bruce, welcome to the show today. Thank you so much for coming. So we're here today to talk about climate change and shareholder engagement. And the big question for most of our clients when we speak to them is, why should we own a company that is emitting versus just divesting from it? Can you give us some clarity around how Federated Hermes works with shareholder engagement on those issues?
Yeah, certainly. And that's certainly a big question. And let me explain a little bit the background to the work that we do and why we think this is the right way to go when companies are exposed to big issues like climate change. So at Federated Hermes, we have a long history of doing stewardship work, and this goes back to our roots where we were the in-house asset manager for the largest corporate pension scheme in the UK, the British Telecom Pension Scheme. And so we took a long-term approach to our investments, and that meant looking after and engaging carefully with the companies that we've invested in. And we've been doing this for 30 years, but we then started to take on clients as third-party clients who would join us in this endeavor. And that way we could then have a much larger and better resource team than any single client or organization would be able to have on its own. And so in recent times, we've been increasing the size of that team as we've increased our asset base. We now represent over $1 trillion of assets, and we have a team that is now over 60 professionals doing this important work. And we've been around at some of the big events, for example, the founding of the Principles for Responsible Investment and the initiation of the Climate Action 100 Collaborative Shareholder Initiative. So that's a little bit about the background. Now, shall I turn to your point about why we would continue to invest and engage with companies exposed to climate change?
Yes, please, absolutely.
So I mean, I think the first thing to say is that nearly all companies have an exposure to climate change because our economy is still not yet net zero. So this is the real world that we need to deal with. And the world is committed at the highest level to a transition to ultimately zero emissions. So this is a shared endeavor that we all need to be involved in, and you can't really avoid it by just picking and choosing certain types of investment. And engagement is the process by which we take companies over that journey. And we do this in a way that is supportive, collaborative, because we're working for the same goals in the end. This is the outcome of lower carbon emissions for the whole of the economy, but also the successful preservation and creation of value at companies. And so we need to partner with companies and explain the type of changes and support them through this transition. And that is essentially what stewardship is really about.
And you find that companies respond better to engagement and stewardship versus divestment?
Yeah, so certainly companies always want to keep their shareholders, and they want to ultimately they exist in order to deliver value to shareholders as well as wider society. And so divestment is never the route that a company wants to see. And it's also not really what investors want to see, because we want to have the opportunity to choose a broad portfolio of investments on behalf of our clients. Now, when it comes to, I want to go into engagement and explain how I think it works. But maybe I should just say a little bit about divestment and how it doesn't work in most cases. Because if you divest from a company, if any investor divests, then you've lost that natural shareholder right to influence the company, to recommend and make votes at the shareholder meetings each year. And so the company, unless it's actually in fundraising mode, which hardly any large companies are, especially the more fossil fuel related, they'll be paying dividends back to their investors rather than, or buying shares rather than taking investment. Then you're not affecting the capital and the real decisions of the company by divesting. So that's the big disadvantage. I think the time when divestment can make sense is where there is a strong belief that the company has no value creation pathway to a sustainable business model. And you could take that view based on investment beliefs, and you could take that view either at the sector level or at company by company level. And so it can be rational to take the view, say, of heavily coal exposed companies to no longer engage because there isn't a value pathway that can work.
So Bruce, is engagement on climate change working today?
Absolutely, it works. I think that at the moment, investors are the single biggest force at work in the economy, making change happen at companies. And the reason for this is that companies have received the very high level societal signal that the world needs to decarbonize. You see that articulated in the Paris Agreement on climate change, and in target setting by individual nations, net zero now in Europe, indications the US will ultimately go in that direction as well. But this high level signal is then not matched by supportive policy. And yet investors take that long-term approach. They look over the horizon of the short term and can see the ultimate need and inevitability of this transition. And so we're the ones who are putting the pressure on companies to say, you need to now get your transition plan working. And we've seen this happen in a number of places. So the first area I'd highlight is oil and gas, where now a range of the oil majors have committed to net zero emissions as their corporate ambition, and are now setting pathways to achieve that. So BP, for example, has indicated the reduction in emissions by 2030 it expects to achieve, and a reduction in oil and gas output of perhaps around 40% by 2030, while it increases its investment in renewables. You see other European majors in a similar category. Utilities making big progress. Duke Energy, one of the US's largest emitters, now has a net zero target and is putting in place its pathway to decarbonize. Dominion Energy also similarly has a big shift. And the auto players, you've got the remarkable situation of Tesla, the pure electric car maker, now having a market cap that is higher than the other big automakers in the US, GM, Ford, and Fiat Chrysler, and also higher than any other car company last time I looked. So, this shift in value that is following those decarbonisation strategies is really very clear to see. So a lot of this has come through investor pressure, and this is how we can see the changes taking place. And we've published a number of case studies that show how our engagement has made a change at companies, which we'd be happy to steer people towards.
So across the world today, we're dealing with all kinds of physical climate risks. Do you think that's adding help or fuel to the engagement process? And what do you think is up and coming in the next year on climate change stewardship due to all of the issues that we're seeing in the world today?
Yeah, I think that the constant visible reminder of climate change is helping to keep up the momentum. It's not the way we'd like it to be, but I think it's inevitable that this will happen as we get more frequent and intense weather events and associated environmental change. I think the wildfires have been a particularly visible way of seeing this, and California, of course, but Australia dramatically changed the perception in Australia on climate change, which has got quite a polarized debate, just about 50-50 in favour and against faster transition. So this will continue to happen, and I think that what we will look forward to is a continuing tailwind of policy rising and ratcheting, and it may come unexpectedly. So if you look at the events around the tragic death of George Floyd, you can see an issue suddenly turn very quickly, and we saw similar thing happen in the UK with a campaign called Extinction Rebellion, which has helped to shift the government here into net zero emissions as its target. And so I think we could see rapid change take place in the policy landscape.
So I'd like to bring in Mark Sherlock. He's head of US Equities at Federated Hermes. So Mark, do companies actually listen to you? Can you give me some examples of what's actually working out in the marketplace?
Sure, thanks, Jeff, and thanks for having me along today. As you mentioned, I come at it from this issue of perspective of investor, and I think that we really must keep investing in CO2 emitting companies if we are to affect change. Specifically on your point, we've been engaged in businesses for very many years now and have a huge number of successful engagement outcomes that we're very proud of. Specifically, you ask for an example. I think perhaps the most
controversial examples is Alliant Energy, which we've held for a number of years in the portfolio.
And indeed was the worst emitter of CO2 in our portfolio. At the time at which we started engaging with the business, the reason that it scored so badly was that 40% power generation came from coal-based production. Over the course of time, we are long-term investors. These are multi-year engagement agendas. We've managed to, in conjunction with the company itself, convince them to commit to reducing that, and indeed they've made significant strides already. So from a base of 45% coal-based generation, we're now down to 25% coal-based generation. Conversely, renewables generation up from 5% to nearer 35%. Now, this represents several $1 billion worth of investment. The achieved from renewables is directly tied to the CEO's bonus. So it's a neat example of CO2 emissions down, profitability up as the company decouples from inefficient coal plants and switches production towards much more efficient and renewable sources, and ultimately creates a win-win both for the investor and for those seeking improvements in climate change.
And lastly, Mark, you have all different companies reporting differently around their carbon emissions. How do you rationalize that or balance that from company to company when you're doing engagement?
It's a great question because, as you say, the data set that we're dealing with is often incomplete. I look specifically at the small and mid-cap end of the market, so in simple terms, companies that are not in the S&P 500. And there is huge variability in the disclosure that those companies are able to provide. I mean, most obviously, it skews by size. So the larger the company, the greater the resources they have in order to make disclosures. But it also varies by industry. Most obviously, utilities have a legal obligation to disclose a lot more than some other types of business. It can also be affected by the state that the company is resident in. And of course, all this data is ultimately backward looking. So it's a very complex situation. The way we approach it is to look at that data with some skepticism. Really, I think it's about knowing the companies that you own. As I say, being long-term investors, we have significant relationships with these businesses, discussing the issues that affect them with regards to climate change and where they might focus their energy. So if they have limited resources, they get the biggest bang for their buck. As I say, it's really about knowing your businesses, engaging with them, and trying to encourage them to think about and action things that will help to combat climate change.
Bruce, we're talking about carbon emissions, and that's in relationship to stranded assets and carbon tax, which obviously in Europe they're dealing with already. But what about the act of physical risk itself? Is Federated Hermes starting to look at TCFD adherence and looking at whether companies are actually prepared for a world that has 2-degree warming or more, and what those physical risks might be to those companies? And does that factor into your due diligence process today?
Yeah, the physical risk profile of companies to climate change is a really important question, and it's one of the questions that we ask companies in our engagement. We ask them to look at different scenarios of climate change. Now, the low carbon scenario tends to be one focused on lower physical risk, but more policy transition risk. But the high carbon scenarios are the ones where you're going to see the bigger physical challenges. And we're talking things like flooding, but also hurricanes, high storm events, and just heat transition, which has caused trouble with technology providers, the internet facilities not working in times of high heat, and other facilities not functioning as you would expect. And we actually at Federated Hermes, we have an asset locator piece of software which enables us to see assets that are in different locations at companies and how exposed they are to for example, water stress or to flood risk. And that enables us to pinpoint our engagement that much better. So I think that we'll see more sophisticated use by investors of data feeds that are very specific to individual companies and the physical exposure risks that they have to climate change. And that will become an even greater source of discrimination between good and less good investment opportunities.
I really want to thank Bruce and Mark for joining us today. Federated Hermes is leading the way on shareholder engagement, and we greatly appreciate the work that you guys are doing around climate risk and climate change. So thank you both very much.